Hello, everybody. I'm Dan Geiger. I'm a reporter with Business Insider, and I cover commercial real estate. I've covered commercial real estate for many years. Before I was at Business Insider, I was at Crain's New York. Always have taken a great interest in the New York City real estate market, and I'm happy to be here on the NYC Real Estate Expo with Bob Knakal, who is a very, very distinguished person in New York City real estate. He's the chairman of New York Investment Sales at JLL. And Bob, I've known you for years. I know you have just an incredible knowledge of the market. So welcome and thank you.
Danny, it's always great to be with you, and appreciate the New York Expo for having me on today. And
you got a much better background than I do, Bob. I'm in this
just in my office here on Madison Avenue, and
oh man,
always great to be with you, Danny. Great to see you.
Well, thank you. And it's funny because now that I'm at Insider, I cover national stuff, and I have this what I think is kind of like this opportunity to get like this different perspective of what's happening around in other cities and what's happening in other markets, and coming back to New York. And New York's a really huge and important market. And I guess not everything's the same. You hear a different story in Miami, you hear a different story maybe in San Francisco. But I wanted to ask you, I'm interested myself, where do you put the state of play today? Where is the New York City investment sales market right now?
Wow, well, that's a very big question, and I think in order to really understand and appreciate where we are now, it's important to take a look back from 40,000 feet and see where we were, how COVID impacted things, and where we're going. So, I always like to look at volume of sales because I think it's very indicative of investor and market participant psychology, seller psychology. And in the volume area, we look at two volume metrics: dollar volume of sales and number of properties sold. If you look at those two metrics, very clear that the top of the market, the peak of the cycle was in 2014 and 2015. In 2014, more buildings sold than ever before in the history of New York City. In 2015, we had higher dollar volume than ever before. And we knew at the beginning of October of 2015 that the music had stopped, the bull market was over, and the New York City investment sales market was entering a correction mode. And that played out in 2016, just as every year at the beginning of a correction plays out, where prices look like they're going up, comp value, the value of comparable sales goes up a little bit, real value is lower, and that manifests itself in seeing the volume of sales drop significantly, and that's exactly what we had in 2016. From 2016 through February of 20, we had both the volume of sales from a dollar volume perspective and a number of properties sold perspective had fallen year over year. By February of 2020, the volume of sales was down about 56% from the peak. Values were down only about 10 to 12% on an average over that period of time. And then COVID came along in March of 2020 and converted what was mostly a volume correction into a value correction. And that value correction was particularly acute in Manhattan, much more so than in the outer boroughs. The diminution in value in Manhattan, if it was a 10, it was only a 2 or a 3 in the outer boroughs. So it was only about 25 or 30% of the reduction in value occurred in the outer boroughs that Manhattan experienced. We get into 2020 and we look at the metrics and we're trying to figure out where the bottom of the market is. And if you look at the second quarter and third quarter of 2020, they're both very, very minuscule dollar volumes of sales. They were each below 2 billion. I think it was 1.8 or 1.9 billion in the second quarter and 1.2 billion in the third quarter. And then the fourth quarter comes along and all of a sudden there's a big increase in volume. And we said, well, we're coming out of it. It's great. We're coming out of this doldrum. And then the first quarter of this year was absolutely horrible. Only 1.1 billion in Manhattan. And that was the lowest quarterly total going back to the depths of the financial crisis in 2009. And then we had the second quarter is 3.3 billion. It looks like, oh, volume's coming back. And then the third quarter was only 2.6 billion. So, interestingly, the investment sales market through the first three quarters of the year is on pace to be down to 9.5 billion for the year. And just to give you some, again, frame of reference, in 2015, the dollar volume of sales for deals over $10 million in Manhattan was 57.5 billion. In 2020, it was 11.1 billion. And this year, through the first three quarters, it's on pace to only be 9.5 billion. Now, that being said, we anticipate an extraordinarily robust fourth quarter. The contract activity we have had has been remarkable. The city bouncing back the way it has been remarkable. And we really anticipate that that volume is going to be significantly increased next year versus this year.
And what's driving that bounce back, Bob? I mean, what's changing now? Just that finally people are turning the page on the pandemic, that life, it doesn't feel still like life is returning to what exactly you'd call normalcy, right?
Yeah, well, normalcy is, who knows what normal is today?
Yeah, there might be a paradigm shift from this whole
Yeah,
thing.
but I think what is driving this is there's several different things that I think are driving the recovery. Number one is that there's investor sentiment that there's been pent up demand, people who have wanted to sell and haven't been able to or have chosen not to. There is a demand, pent up demand from buyers who have capital that want to put capital into the marketplace. There are folks who believe that, this is the longest correction we've ever seen, at least in the past 38 years. This is the longest correction we ever had. The correction during the S&L crisis in the early 90s lasted only 4 years. We're now, well into year 5 of this correction, and folks are believing it will bounce back. And you also have some dynamics where, real estate markets around the country have gotten so robust that, some people, like in the multifamily sector, for instance, people are looking at New York City as a yield play. I never thought in my life I would ever say that, but, cap rates on multifamily today outside of New York are lower than they are in New York. That's never been the case. Multifamily cap rates have always been 150 to 200 basis points lower in New York City than around the country, and that has flip-flopped now. So a lot of interesting things going on in the market, and a lot of divergence of opinions. There are some people who remain very, very bearish on the future of the market here, and there are some people that are very, very bullish. And that's what makes a good market, because you have people wanting to take advantage of current conditions as they see it.
What are the threats that you see, Bob, to the market, to the recovery, to New York bouncing back?
Well, several. I think, again, Danny, I think you have to look at each sector of the market to handicap where you think it's going and what the threats are. The threats are different for each sector. Let's look at the multifamily sector. We've had significant policy and political headwinds in that sector. If you look at what has happened with rent regulation, particularly in June of 2019, those laws just were so against the industry, so against the health of the housing stock. It really changed investor sentiment significantly. And for seemingly irrational reasons. I'm a big Yankee fan and always use this as an example when talking about the housing stock, because I think it really is very illustrative of what has happened here. But, if you watch the 1977 World Series, you remember the Goodyear blimp panning out around Yankee Stadium, and there were 6 fires going on within a few blocks of the stadium. And Howard Cosell famously said, "Oh, the Bronx is burning." And the reason the Bronx was burning is because it was more economically feasible for folks to burn their buildings down and collect the insurance money than to invest in the housing stock. So the MCI program and the IAI program came along. That created a tremendous incentive for the private sector to invest in the housing stock.
But this all precedes the I hear what you're saying, that the landlords don't love the changes in the rent regulations in 2019. Is there something, just in reflecting on all the changes that happened because of the pandemic, do you see, what concerns do you have about bouncing back from all of that?
Yeah, well, generally, again, in the multifamily sector, it's political headwinds. And it's expected that, the headwinds could even go further against owners' interests in the next legislative session. We're relative to the way the pandemic has impacted things. Well, clearly you have a lot of tenants that aren't paying rent or haven't been paying rent because of the eviction moratorium. How is that going to play out? What's going to happen when the courts open up for these cases? We're seeing that a lot of rents, and the estimates are anywhere between 50% and 75% of current free market rents in New York are higher than they were pre-pandemic. Now, there are some folks that say, well, that's because so many people are coming back to work, although physical occupancy in office is only about 30% plus or minus, and we'll talk about office in a second. But with physical occupancy of office only 30%, these folks are not coming back to the city to work. They're coming back to live, to enjoy the nightlife. They want to move out of mom and dad's house. So there are a number of reasons why that's happening. But then some folks are questioning whether the fact that there's such upward pressure on rents is caused because it doesn't make sense for a landlord to re-rent a rent stabilized unit that becomes vacant. So or have units been taken off the market? If you look at the retail sector, where are retail rents going to find their footing? Some folks think that rents have bottomed out and that there'll be upward pressure on retail rents moving forward.
Do you see any reason, Bob, to believe there's a bounce in the retail? We heard so much about retail was already in trouble before the pandemic. And of course, the pandemic really, made those problems much more severe. Is there any reason to believe that retail has hit a bottom, that tenants are coming back to you do hear about leasing? I'm just wondering.
Yeah, no, there are new stores. Look, a lot of online businesses want to have a brick and mortar presence. There are a lot of folks who are saying, I had a store 5 years ago, and now I can rent the same amount of space for significantly less money. And so there's an opportunity to do that. We're big believers in New York. New York is the greatest city in the world, and it's going to bounce back. In fact, it's bounced back a lot faster than most people anticipated it would, and that's a great thing. But this issue of physical occupancy in office is critical because if you look at retail, particularly in Midtown,
it depends on office traffic, right? People going into the, and it hasn't come. I mean, has that surprised you, Bob, that there hasn't been much more of a return to the office? I don't know what it is today. What, in the 30s, somewhere around there?
It's around 30% plus or minus. And, that it's surprising. Everybody was saying in the summer of 2020, everyone was saying or hoping that after Labor Day,
right, we're all going to come back.
It was going to get back to great levels. And I think pre-Labor Day of 20, occupancy was 7 or 8%. Everyone was expecting a big bounce, and it only got up to 12 or 13%. Do
you think it'll happen now? Do you think
then we said in early 2021, everybody said, yes, it'll be after Labor Day. It was just the wrong Labor Day.
Yeah.
It was Labor Day of 21, not Labor Day of 20. And we haven't seen, a big jump. Again, we're still hovering around 30. We're hoping that, maybe in January, we'll start to see the numbers climb significantly. But we need folks to get back to the office. Certainly, people being back in the office is going to help retail, particularly in Midtown.
And Bob, what if that doesn't happen? What if we've sort of hit this change in the way we work, and occupancy never rebounds past, let's say, 50% or 75%? What would that do in your mind?
Well, I don't want to hypothecate about that.
Right.
I think that. I think it will come back. I know that the work from home experience is different for different people and different companies.
That's true.
And you could say, well, there are people are more efficient working from home, or people are less efficient working from home, depending on what you do. I notice if you're a Seinfeld fan, you know that the stop and chat can create a lot of idle time during the day, but you have to try to avoid that, or at least you're more conscious of it now. But I think for company culture, for development of young people, for a host of reasons, being back in the office is great. And I thought, personally, working from home was very, very efficient for me. I track my productivity based on the number of owners that I speak to every week.
Yeah.
My goal for many years has been to talk to 50 property owners every week. Working from home during the pandemic, I was over 100 every week. Wow. So much more productive. And I thought, well, gee, I'll be working at least 1 or 2 days a week from home. Well, since I've been coming back to the office, I'm in the office 5 days a week. I didn't think that was going to happen, but I enjoy being in the office and, being with people, right. And particularly for the development of the young folks in the office. I think it's important for folks to be around. What's
JLL's own occupancy? You guys have the office, what, 330 Madison? Am I remembering?
Yeah, 330 that? Madison at 42nd and Madison. I don't know what the exact numbers are, but for many, many months, we've been, inviting everyone back to the office, and occupancy has been very, very high for us. I think I read a report the other day that real estate companies are leading. I think we have close to an 80% occupancy, and for good reason. We're trying to lease office space. We should be in office space. So, I think our occupancy has been very, very high and has been for a long time. And, happy to be back in the office.
Interesting. You talk to a lot of owners, obviously. In recent months, we've heard about like other municipalities, Miami, for instance, that have attracted office tenants that you might typically hear about leasing space in New York. Do you hear from developers or owners that they're turning their interest and their focus and their money away from New York and going to those cities? That's
a very interesting concept, and I think a big part of what I try to do in the stuff, I write a regular column for the Commercial Observer, and I've done that since I think 2009. But a big part of what I write about is trying to connect dots between the economy, public policy, tax policy, and commercial real estate. And you've seen this is playing out because those dots are all interconnected. Tax policy affects behavior. And, there's some very, very smart people that say tax policy does not impact market participant behavior. In commercial real estate, that's completely untrue. If you look at the New York City investment sales market, you'll see that over the past 38 years, 3 of the top 5 years in terms of volume of sales were catalyzed by changes in tax law. 1986, 1998, 2012. And so it has a big impact. So when you look at companies that are making decisions to relocate, tax policy is a big one. I've often said that LeBron James went to the Miami Heat as opposed to the Knicks because he didn't have to pay any state income tax. And if you look at what that meant for every game that he played, it was significant.
It added up for him. But New York's not going to lower its taxes, right? No one's going to see. The city, the state is so dependent on property taxes and the various suite of taxes it levies from real estate. It's not realistic to think that it's going to go down. I think we're already the highest in the country now.
Well, if everything that has been proposed kicks in, we will be. And so that's a decision that folks have to make. Do you want to domicile your company here? Do you want to live here? There are tremendous advantages to being in the city relative to cultural aspects, nightlife, lifestyle, et cetera. But I think there's a lot of optimism here. Our new mayor, Eric Adams, I think, has created a lot of optimism within the real estate community, within the business community, within the non-business community. And so we're encouraged by that. But, the decisions and policy, public policy has ramifications on the decisions that people make, where to live, where to work,
Right.
where to have your business. And so it's a real issue.
Let me ask you another question. Have you seen owners? I know you handle a lot of multifamily deals, you handle office buildings, you handle development sites. Have you seen any investors coming to you, changing the types of properties that they're interested in, that they don't feel, let's say, that office is vital or that retail is vital? They want to buy, I don't know, something like biotech, or they want to buy industrial. Do you feel those offers, and do you find yourself actually handling the sale of different asset types now because of that?
Yeah, well, the constituency of my practice has been pretty consistent.
Yeah.
But I think from an investor's point of view, yes, there's been significant changes, and investors kind of adapt to market conditions, changing market conditions. There've been a lot of folks who are interested in life sciences real estate plays and industrial real estate plays, given how robust those market sectors have been.
Right.
In the multifamily sector, 3-4 years ago, when the political headwinds really started to blow against the industry, a lot of my clients, and this is probably the most depressing trend I've seen in my career, was these high net worth individuals and families who for decades only bought New York City multifamily were all of a sudden buying around the country. And I would say probably 85 to 90% of them now are investing outside New York City. There's still a thin slice that have said, we're not going to geographically diversify, we're all
Right.
in, we're going to keep buying. But you also have folks that are switching the types of properties they're buying, mainly, I think, because of the dissatisfaction with the returns that they were getting in their main asset class focus. And so we've seen folks jumping around doing, buying transactions that were not typically down the middle of the plate for them.
Gotcha. Bob, there's a lot of chatter right now about inflation that, there was recent data that showed inflation had hit, I think, a 30-year high. And is that good for real estate, or is it going to be bad for real estate? I would assume that higher interest rates are going to come with inflation to try to control it. And that, the industry has been for years, it's been used to having these wonderfully low rates. And I'm interested to hear from you what you think the repercussion of that might be. And of course, inflation might also drive up rents, and it might also drive up value. So, how do you stack those together?
Yeah, Danny, it's a question with inflation is the same kind of, I give the same type of answer that I would on interest rates. It's not whether interest rates go up or whether inflation goes up. The real answer is in why it happens. If interest rates rise and inflation rises for the right reasons, that's a good thing. Could be a very good thing. If they rise for the wrong reasons, it's a bad thing. So if inflation is going up because of reasons that will increase net operating incomes, in the same way, if interest rates go up because there's robust economic activity, and if interest rates go up, cap rates go up, so that should mean value goes down. But if the corresponding net operating income goes up as well, you actually could have an environment in which you have higher cap rates, but higher values because net incomes have gone up so much. So I think, it's a function of, why are we seeing the inflation we're seeing? Is it because of supply chain issues? Is it because of something more fundamental? Is it because of all the trillions of dollars that we're spending? Apparently, these trillions of dollars programs cost $0. And so I say, if they cost $0, make it 20 trillion, 50 trillion. What the heck? If it doesn't
It's just
cost
lost all, as you're saying, it's lost all,
well, I think
the scope of it is, it's almost become esoteric. Bob, what you just said, though, would seem a little bit troubling for real estate, because you're saying there's inflation, interest rates may go up. In fact, most people think that they will, but you don't have a lot of, the demand for office space has gone way down. So, I'm talking about the office sector here for a moment.
Well, we'll
He used
see.
to
I
be a
don't know
cowboy?
that, I don't know that the demand for office space has gone down, Danny. And I think
I think it has.
the interesting thing about the office sector is that the fate of office is going to play out over a longer period of time. In the hotel market, you see things happen instantaneously. Leases are for one day. They're highly reactive to what
Right.
happens in the market.
Right.
In the office sector, leases are 5 years, 10 years, 20 years,
Sure.
and
Sure.
sublet spaces come on the market, come off the market, come back on the market, but you won't really know what that company is thinking about until a year before their lease is expiring. And when you see an announcement about a XYZ company took 150,000 feet of office space, that in and of itself is meaningless. Did that tenant come out of 100,000 feet? Or
Right.
did they come out of 200,000 feet?
Right.
If they came out of 100,000 feet, that's great. If
Great.
they came out of 200,000 feet, not so much. So the question for all these things is why? What's the reason behind the movement in interest rates, the reason behind inflation, the reason behind the decision to take 150,000 square feet?
Sure.
You have to look at the why, and then you can figure out whether that particular thing is good, bad, or ugly.
Wow. We could listen to this for about a couple more hours. I wish. A real honor, Bob. Like always, you're just amazing. So much information. Dan, you did a great interview, and it was an honor to have you here with us, Dan. Thank you so much. Thank
Okay,
you,
Anthony,
everybody.
thanks for having me. Danny, always
Oh.
great to be with you. And I'll just leave all of you with a thought. We've come through some tough times. New York City is the greatest place in the world. Just keep your head down, do your stuff every day, keep discipline, keep the faith. And if you're going to be working anywhere, this is the greatest place to work. So go get them. And if there's anything I can ever do to help anybody out there, please feel free to call on me at any time.
Great. Thank you, Bob. And we will have you on a lot more. I mean, we'd love to hear from you more. Thanks, Bob. Thanks, Dan.
Thanks,
Take care,
everybody.
guys. Bye-bye,
Thank you.
guys.